Hello, everybody. We are live with this webinar on the future of finance at the most extraordinary, appropriate time. We have an enormous amount to talk about. It's a fascinating and huge topic. So what we've done is we've got the smartest, the best commentators absolutely on the planet Earth to talk about it. Arthur Goldstuck, who is a publisher, entrepreneur, commentator, media analyst. Sorry, and what else?
Astronaut.
Oh, astronaut. That's true. That's true. Okay. And Dominique, Collett, who has been in the field for ages and ages. She heads up RMI, that's Rand Merchant Bank's Fintech initiative called Alpha Code. RMI is the holding company of First Rand, Discovery, Outsurance, MMI, and Hastings. She has been involved in thinking about fintech for ages, and as you will hear, is extremely knowledgeable about all of its different aspects. Thank you very much for joining us. Good afternoon. It's a weird time.
Certainly a weird time. Certainly trying to do these things in COVID.
Dominique, can I ask you, what is the most weird thing that happened this week? Do you think it was the Bitcoin going over $50,000, or do you think it was WallStreetBets, the WallStreetBets GameStop going bet going all kind of wrong, and them coming crashing down to earth? Which has been absorbing your attention most avidly?
Sure. So they're both fascinating topics, and they're both very big topics, right? They kind of talk about the driving forces of fintech, right? The impact of social media, the rise of a millennial consumer who plays by very different rules, the power of technology. So I think they're both equally interesting for different reasons, but there's also a lot of parallels. And I think all it's doing is it's bringing to the fore the big trends that have been driving fintech for a while. And it's just making it, it's now being discussed around the coffee table. For the first time, my job is quite interesting to my friends and family because they're reading about stuff on the front page of the newspaper.
Let's start
now, it's been what's this weird thing you do out there. So
yes. Well, let's start with WallStreetBets. Just explain maybe what happened very briefly. I mean, and what WallStreetBets is, and I suppose you need to just tell people a bit about what Reddit is too. A big mouthful, I'm sorry.
Sure. So I suppose trying to simplify it in a nutshell. So Reddit is an online forum. It's a discussion forum, which a lot of millennials have embraced. It's actually been around for a long time, but it's really a chat forum. And what happened was that there was a chat forum on Reddit called WallStreetBets, where retail investors, a lot of young retail investors, some institutional, but mainly retail investors, started to discuss investment ideas. And one of the ideas on there was around sticking it to the hedge funds. That's kind of how it started. So what the idea is, especially in the US, this is a big practice, the hedge funds short stocks. So what that means is that they bet that a share price will go down. And how they sort of trade that is that they borrow stock from another holder of the stock, and they bet that they're going to be able to buy it back at a lower price in the future. It's how a lot of hedge funds make money. And the retail investors in this forum decided two things. The first one was that the hedge funds had decided to short a stock called GameStop, which was like our equivalent of Musica. I think that's the best way to describe it, kind of a physical store that sells gaming products. And they said that there was a fundamental investment case for the business actually being more valuable than what it was currently being valued, but also they didn't like the fact that hedge funds had decided to short the stock. So they decided to rally behind it. How a lot of these players then decided to rally behind it was using a fintech called Robinhood. So Robinhood has enabled every person, sort of like the man on the street, to trade stocks in the US. So they've made it really easy for people to sort of get in on the stock market game. So they came in and they started trading on Robinhood. The price of GameStop went through the roof. The hedge funds, for lots of complicated reasons, then were on the wrong side of the trade. Robinhood then had to stop the trading because they had to place capital at the clearing agency. And then these same millennials got very angry because they lost a lot of money on the trade. So it's actually quite a complicated matter, and I've tried to simplify it in a way. The millennial consumers said, let's support the underdog. And unfortunately, they got caught on the wrong side of the trade, actually.
Yeah, I mean, it's worth noting how many people are on WallStreetBets now. It's about 9 million people, I think, right?
And Robinhood has 7 million on its platform. I mean, these are big mass retail platforms, right?
Yeah. So, I mean, what it really teaches us is that there is a new force in investing, and that is small investors who are rallying each other to invest the same way. So now that gives rise to this idea of a meme stock. This is, in other words, a stock which is attractive not because it makes something brilliant or that it's got great potential for the future or that it has huge profits, but that it has a nice feeling about it and a nice associated with it. Sorry, I'm diminishing that. This is, but it is extraordinary how the power of a large number of small investors, if they all start doing the same thing at the same time. And apparently, just today, they have decided to short South Africa, or at least some. Do we care about this or not? Do we? I mean, it is just to reflect a bit. I was following the WallStreetBets, and when the share price went up, everybody was absolutely delighted, right? So at that point, the people on WallStreetBets were saying, "Nobody sell. Nobody must sell." Now, I happen to know that if a share price has gone up and somebody tells you don't sell it, you're about to get a spear in your chest. So then I think we've got a graph of what happened with GameStop. And by the way, I mean, it does seem like a missed opportunity to me that local investors didn't get behind Musica before it closed. We could have saved a lot of CDs if only we'd done that. So this is this is the graph I was going to show, but later. Sorry about that. I beg your pardon. This is the Bitcoin graph, which looks. So this is just a report that Bitcoin is now over $50,000. There it is. There's GameStop going up and down. Looks a little devilish if you. But I mean, it is interesting that it's has settled higher than it was beforehand. So maybe the WallStreetBets investors have got something to show for their investments. It's hard to know.
Tim, but I think what's interesting about that is, and it's good that we're talking about both at the same time, because I think there's a lot of parallels. So at the time that the whole GameStop WallStreetBets was happening, you had Elon Musk come onto Twitter and talk about Bitcoin, and suddenly this thing got pushed to stratospheric levels. And I think what it does is it just shows the power of social media and alternative platforms, and how these influencers can drive prices of assets, not based on fundamentals necessarily, but based on sentiment. And it's a very, again, what's driving the forces behind Bitcoin. You've also got lots of retail traders who are going onto platforms like Luno and are investing in assets like Bitcoin, and it raises all sorts of questions of, should these platforms be more responsible? Are these people sophisticated enough to understand the underlying trades that they're trading in? Are they prepared for the losses that they're coming in? It's raising so many questions.
Yeah. Arthur, you followed sort of tech in general and in South Africa very closely. Obviously, the pandemic has had an effect on how how we're using tech. This is sort of obvious to everyone. This is why we're sitting here on Zoom. But how do you think that the pandemic has affected specifically fintech? Is it different from the way that it's affected, other spheres?
It is probably quite dramatically different, and in fact, it brings to mind that a famous scene from Monty Python's Life of Brian, where the rebels are having one of their interminable meetings, and one of the guys says, what have the Romans ever done for us? And after going through a litany of things that the Romans have done, the John Cleese character says, well, apart from sanitation, medicine, education, wine, public order, irrigation, roads, a fresh water system, and public health, what have the Romans ever done for us? And that's a little bit like, what has the pandemic done for fintech? Well, aside from contactless payments, mobile money, QR codes, remittance services, startups cropping up like Namaqualand daisies after the rain. You would know about that where you based, Tim. It's a case of you can't actually keep track of the many ways in which the pandemic has accelerated fintech innovation. Just yesterday, for example, MasterCard and MTN announced a new virtual payment system whereby mobile wallet can be used to pay at any global e-commerce site. So people who don't have a bank account or don't have a credit card, but have a mobile wallet can shop at global e-commerce sites. So you start getting a sense that thanks to the pandemic, or rather due to the pandemic is perhaps a more polite word to use there, the world of fintech is probably a decade advanced over what it would have been had there not been this massive momentum and propulsion from the demands of the pandemic.
Yes, I know. I mean, I saw an interview, I think it was with Bill Gates, and he said it very simply. He said, where would we have been without all of the kind of technological advances? I mean, Dominique, maybe we should talk just a little bit more about Bitcoin. I did get some questions about, you made the mistake of explaining the WallStreetBets thing so brilliantly. Maybe you can explain simply Bitcoin for people who maybe not so familiar with it. But it's there are all kinds of parallels with all kinds of other aspects of the fintech world. But I just wonder whether we've seen really a big sea change in the take up of Bitcoin. It's not so much that, that Elon Musk has now invested it and so on, but now some banks are looking at it much more closely. I think maybe you can update us on that aspect of it too.
Sure. So I think, if we just take a step back, that Bitcoin really came out of the global financial crisis. So it was actually, it was around 2008 that the concept was developed. And it was very much against a backdrop of people losing faith and losing trust in banking systems and in governments. And it really started out as very much, an alternative to the current way of the world that we knew it. That was an alternative to the existing banking system and to the existing government system. And it was premised on the idea that currency is, the concept of trust in currency is quite arbitrary. It's really about how much momentum do you have on it. Nothing really backs the US dollar anymore since the depeg from the gold standard, but people fundamentally believe in the dollar. So that, and Bitcoin for many years was kind of an underground movement. It was a lot of stuff, anarchists who kind of believed in it, and there was a lot of sort of noise around it being used for nefarious purposes. But it started to come to the mainstream, I'd say probably about 6 years ago. The financial world sort of woke up to the power of Bitcoin. The conversation then moved more towards the power of blockchain as a technology. And they said, wow, this technology that Bitcoin is based on can be used for anything. We can put share certificates on it. We can put property certificates on it. We can change the world with blockchain technology. And then the conversation shifted back to Bitcoin as a store of value. So it's interesting to see how these things go in swings and roundabouts. This does have some, there's some sense of what happened at the end of 2017, where we saw sort of a bit of a Bitcoin bubble where people were talking about it and became mainstream. There does feel like now that there's more momentum behind it. I think what's happened is that some large financial institutions and asset managers have started to seriously consider Bitcoin as an asset class. So Bitcoin is no longer considered as an alternative technology to, for example, money transfer, but they're saying this in and of itself has value. It has value because people start to use it. And I think that's why Elon Musk coming in and saying that they're going to be buying Bitcoin and they want the Tesla rails to run on Bitcoin is so powerful. Because they're saying that this currency is going to become tangible and it's going to have value and it's going to be fungible. So I think it's interesting. I think I've been a Bitcoin bull for a long time. I sort of started investing in Bitcoin many years ago. Are we going to see another boom and bust cycle?
You didn't. Oh, no, that is a terrible, terrible thing to tell people. Okay, just fess up now. How many Bitcoins have you got?
Can't tell you that.
The more important question is, how many have you sold this past week?
Again,
Arthur, how many Bitcoins have you got?
1/10 of a Bitcoin.
Okay, well, that's not too bad. 1/10 of a Bitcoin. That's $100,000. That's impressive. It's sort of like it's a store of value comparable to gold now, isn't it? This is at least the theory of the people who like the idea of Bitcoin, and it's not a transactional tool. Why is it? Why has it turned out that it's because the original idea was that you could use Bitcoin. Anybody with a mobile phone could transfer value to anywhere else in the world seamlessly and without cost. But that isn't panning out. Why is that?
Look, it's just, that's a technological question. I'm sure Arthur will have much stronger views than I do on this and more knowledge of it. But effectively, it's not as fast as some other payment gateways. So the Bitcoin technology just hasn't been built with the level of scale that's required for it to be industrial strength to sort of settle transactions, which is what's given rise to alternative ones like Ripple and Ethereum, with the argument being that Ethereum and Ripple have much stronger technology underlying it to do instant settlement. So it's not as slow. So the problem with Bitcoin, in theory, it can do instant settlement, but there's backlogs on it. And what you're actually having to do is pay the miners quite a lot to process a transaction. So it's becoming quite expensive to do an instant settlement on Bitcoin. So if you compare it to, for example, the processing capability of a PayPal or a MasterCard or Visa, they're far superior at a much cheaper cost, actually. So that's why you've had these alternative coins rising up.
Yeah.
There's a very good reason why people are not buying things with Bitcoin. And that is because most people who are in Bitcoin, looking at it as a potential transactional medium, are aware of the fact that the first ever Bitcoin purchase back in 2010 was for a pizza. And you know the story, Dominique. The pizza costs around $30, or the pizza order costs around $30 from Papa John's, in fact. Very appropriate name as well. And the price of a Bitcoin back then was something like a third of a cent or something. It took, and brace yourself for this, and some people will weep to hear this, the amount of Bitcoins it took to buy that pizza, 10,000 Bitcoin. No one wants to be that guy.
It does seem very, how should I put this, ethereal, the whole cryptocurrency market. But, I do think when I read about it and when I hear about it, it is interesting for people who live in countries with very volatile currencies. So it gives them an opportunity. It gives you, and it's, to some extent that applies to South Africans, right? So I couldn't help noticing that if you look at the countries where Bitcoin usage is rising fastest, it's Argentina, Venezuela, Nigeria, and sort of down the list a bit, but South Africa too. It does confront you with the question of whether or not this is a real challenge to fiat monetary systems. And if it's not a challenge to fiat monetary systems, is it not at least a challenge to exchange controls? Dominique,
absolutely. I think that's been the biggest challenge. So we were investors in Luno, and we've had sort of, it was a fascinating investment, and we really enjoyed working with the team there because it raised exactly these issues. What we saw was that the demand for Bitcoin was incredibly high in emerging markets, because effectively what emerging markets are struggling with is trust. They're struggling with trust and volatility in their governments and in their currencies. And Bitcoin posed an alternative to that. The question around exchange controls is exactly what's kept the South African Reserve Bank up at night. They're aware of the fact that people are circumventing exchange control with Bitcoin, but the question is, how do you regulate it and how do you stop it? And it's something that there's a task team at the South African Reserve Bank that are applying their minds to exactly these issues. You can't stop people using a currency like Bitcoin because it is, it is a good store of value. But how do you make sure that people are using it responsibly and not using it to go offshore? And good platforms like Luno are very ethical, and they make sure that people try to stay within the bounds of what they're supposed to be doing, but not all platforms are as ethical. So it's a huge challenge. It's the biggest challenge that reserve banks and central banks have had around the world. What should they do about cryptocurrencies? It also raises a lot of questions on tax. So at what point should you pay tax? And it's taken a while for the South African Revenue Service to decide that cryptos are a financial asset and are taxable. But I think the challenge with all of these things is that unfortunately technology, and certainly fintech, is running ahead of regulation. Which is exactly the issue that we've had with GameStop and Robinhood. There's questions around market manipulation and what should have been done better. And regulators, unfortunately, are always reacting as opposed to being proactive on some of these things.
Arthur, what's your view on regulation, on the sort of regulation sphere? This is something that you have covered in the past. I mean, do you think? I guess the question is, should we be treating, say, Bitcoin hosts like banks? I mean, should we be using existing boxes to regulate these institutions, or should we have new boxes? And do you think regulators, particularly in South Africa, are sufficiently on top of the issues?
Let's look at it from the point of view of what will it take for cryptocurrency to become accepted, credible, and a standard store of both money and transactional value. That needs the regulator to get involved. As Dominique was saying, the regulators are looking fairly closely at how to bring it into the system rather than to keep it out of the system. I think the biggest mistake they can make is to try to hold it off. You can't hold off technology development, otherwise you King Canute trying to hold back the ocean. But at the same time, you've got to make sure the ocean doesn't swamp your structures near the shore. So that's the first point, is regulators do need to step in. Regulators do need to play a role, but an enabling role rather than a blocking role. That's pretty critical. At the same time, though, they also have a responsibility to ensure that existing stores of currency remain stable. So one of the biggest boosts that Bitcoin had in its first 5 or 6 years was during the Greek financial crisis, when people rushed to buy Bitcoin as a store of value when their pension money was being raided out of their bank accounts. So that was a great example of cryptocurrency stepping in to help people rescue themselves when the authorities wouldn't do it for them. So it's very much a balancing act from that point of view. But to look at it also more long term, I think we have to accept that it's not going to become a standard instrument that forms part of what banks and central banks do for quite some time. It still has to bed down, it still has to stabilize. One of the more interesting people I've chatted with about this over the last few years is a gentleman who goes by the wonderful handle of Fluffy Pony. Dominique, you'll know Fluffy Pony. Fluffy Pony's real name. He sounds like one of those guys, but he's a fascinating person. His real name is Ricardo Spagni, and I think he lives in Plettenberg Bay or Port Elizabeth, somewhere along the coast there. But his claim to fame, his biggest claim to fame, is that he's the lead maintainer of a cryptocurrency called Monero. And Monero is probably the third biggest cryptocurrency in the world after Bitcoin and Ethereum. It goes by the initials XMR, and it trades quite actively. In the time that Bitcoin has increased fivefold or so in the last 4 months, Monero has doubled in value, but very quietly. So there's no hype around it, there's no fuss, and there's no fear of it crashing the way there is around Bitcoin. Same with Ethereum. Ethereum's also increased about fivefold over that time, also inspiring tremendous fear that it's going to crash, whereas it looks like Monero is being actually managed quite responsibly in comparison. So allow South Africans to control these things. Oh wait, Elon Musk, right? But what Ricardo Spagni says is that he doesn't expect that cryptocurrency will truly be mainstream, in other words, part of the mainstream financial system, the banking environment, etc., until the end of the decade. So that's still a long way away, but bear in mind that it's only been with us for a decade, around 10 years. So it's still not quite a toddler, but it's still an adolescent that doesn't always behave itself, and it needs to grow up, mature, and become more well-behaved before people will really give it the credibility that it probably will earn in the long term.
I mean, Dominique, we're getting a whole bunch of questions on topics that we've been talking about. So allow me to just throw a bunch of them at you. But just before we get there, Arthur, I have to say, I mean, I'm sure you've had experience of this too, is that people tend to massively overestimate the time period involved for the for adoption of new technologies. If people are talking about 10 years, then think maybe 2.
It's a well-known equation that says that people completely overestimate how quickly things will happen in the short term, but underestimate how much will happen in the long term.
Okay, so the questions I was talking about, what SARB regulations regarding crypto should investors and consumers be aware of? That's from Gina Mostert. Doug Vinnick says, isn't it time to do away with exchange controls? Or I guess the question is, will things like cryptocurrencies just obviate exchange controls completely? Sharon Carson asks, isn't Bitcoin popular because it's not regulated, and many emerging economies are looking at using it to get money out of the countries where there's foreign exchange control? And here's a very easy question for both of you. If you had to choose between shares or Bitcoin, which would you pick today?
Well, Tim, the question is shares and what, right? Not all shares are created equal, and companies are very different, right? And I think the whole
average shares, if you had to choose a sort of like tracker, index tracker compared to Bitcoin.
Well, what I always, from my perspective, is it's a balance, right? And you should always have a balanced portfolio. So I say to people, understand that when you're investing in cryptocurrencies, it's incredibly volatile. It has very high risk with potentially very high return, but you can also make losses. So never put your life savings in Bitcoin. In the same way, you should never put your life saving in sort of emerging tech companies. It's just very high risk. So there's a place for it in your portfolio. And if you're going to invest in risky things like cryptocurrencies, just invest money that you can be prepared to lose. And I think that's been the biggest issue with Bitcoin, especially since 2017, is that people saw it as a get rich quick scheme. Again, it talks to what happened on WallStreetBets. There was the meme of stocks only ever go up. Well, no, they don't only ever go up; they do go down. But I think people really have to understand what they're investing in, and they've got to just manage their portfolio according to their risk profile. There's a place for good, solid, old-fashioned companies in your share portfolio, and there's a place for volatile assets like crypto.
Sure thing.
There's one beauty about shares, Tim, is that the one beauty of shares is that if you really do your homework and you understand the underlying value of a share and the nature of the company, the sector in which it operates, and also the quality of its management. And now I guess I might be invoking Warren Buffett here, because that's pretty much what he says as well. But if you understand all of those things, then you can invest quite confidently in a share. And as long as you're doing it in the long term, so it's not affected by market sentiment, because in the long term, a quality share will keep rising, even though there are short-term dips and even crashes. And that's the basis of Buffett's investment philosophy.
Yes, but, exactly. With shares, one of the things that we're lacking with crypto, please correct me if I'm wrong, but is that we don't really have a model for its value.
Exactly.
So you can notionally model shares and come to some kind of understanding about what a share should be worth if you compare its earnings to its current value and so on, or even its turnover to its current value. You don't have that luxury with Bitcoin.
Exactly.
Although, Tim, what you're assuming there, is that that shares behave rationally, and it's very difficult. For example, it's very difficult to justify where the Tesla share price is right now, right? Because a lot of these tech stocks are behaving as irrationally as the cryptocurrencies are, and they're being driven on sentiment. I
agree with what you said earlier, Dominique, about you need a balanced portfolio. You can't just be in one thing. The moment you put your eggs in one basket, you are looking for that basket to disappear. And when people talk about losing their life savings, it's because they've thrown it all into one basket. And it is short-sighted. It's even stupid to put everything into one basket. We've seen it with all the Ponzi schemes as well. People get so caught up in getting rich quick, and someone presenting them with an opportunity to double their money and really get wealthy overnight, that all rational thinking goes out of the window. But as I said earlier, you can think rationally about a share that you research really effectively. You can't research Bitcoin in the same way. Aside from the model, there just isn't the research into the underlying value available to you at this stage. And probably that's not going to be available for the next 5 years. So you can buy shares at the top of the market by buying carefully and looking for shares that are still undervalued even when the market is at its high. But I wouldn't dream of buying Bitcoin right now. Someone may come back to me a year later and said, we're laughing at you because Bitcoin is now $100,000. Yes. But my gut feel is that it's a crazy time to buy Bitcoin, but it's not a crazy time to buy shares if you know what you're buying and you're buying value.
All right, Dominique. Just back to the other questions. What are there any SARB regulations that you're aware of regarding crypto that investors or consumers should be aware of?
Well, I think people have to understand that cryptocurrency transactions are being tracked. So I think people who are using it to move funds offshore and circumvent exchange control, banks are tracking that, exchanges are tracking that, and the South African Reserve Bank is aware of it. So people mustn't use it to try to circumvent the rule of law. I mean, we can have a debate about the place of exchange controls in SA and whether or not they should remain. But the reality is that the law today is that you cannot move currency or any assets offshore unless you go through the formal processes. So I think people do need to be aware that the regulators and the banks are alive to this. And they must do what's right within the legal framework.
Yes, I mean the other sort of regulatory aspects of it that's that you should be aware of, I guess, is that there are limits to how much money you can take out of the country. So so that's it's an important part of. But people do have quite big now allowances. So you can invest. I think what is it, R1 million a year? I think you can invest in cryptocurrency without breaching those rules. Dominique, I'm interested in your position as a. In some ways, you stand halfway between the established financial sector and the new financial sector. I mean, my experience of banks is that they're extremely slow to accept new technologies. I don't know whether that's true. I know I know it's not always true of banks. It's actually not true of South African banks. But what do you think banks around the world, on the one hand, and South African banks on the other hand, have been slow to adopt new fintech technologies? And what technologies should they be adopting that they're not?
So I think as a starting point, what's important for people to understand is that probably the biggest investors in technology are the banks and insurers. If you just look at the quantum of money that banks and insurers invest in technology, it dwarfs how much money has gone into fintech. So if you look at the volumes of venture capital that have gone into fintech versus what the banks actually spend on maintaining their systems and investing into new technology, it's orders of magnitude bigger. Right. So I think banks and insurers have been incredibly technologically advanced organizations. The challenge is not technology. And the challenge is not adopting technology. It's consumer behavior and business model. That's more the question, right? So, I mean, I think if you look at it, I always love this story. So in the 1980s, when ATMs were introduced in South Africa, the story goes that they had the brigade of the blue rinse ladies. So consumers were quite nervous about these things called ATMs where they got cash. So what the banks had to do was put these ladies next to the ATMs, and they were, the tunnies and the aunties from the local community who people trusted, and showed people how to use the ATMs. So there's this gap between human behavior and what technology can do. And really what it's about is how do you make your customers comfortable with the technology, and how willing are they to adopt it? And in terms of, are banks and insurers then positioned for when customers do radically adopt a new technology or demand it? And how does that behavior change? So I think it's, that's the one, what especially in the fintech world, people love to talk about software eating the world. But what they forget, and it's back to Arthur's point earlier, is that a lot of the resistance is human behavior. And that's where the big challenge lies. So if I look at it and we talk about how did COVID accelerate things, what it really did, if you look, for example, banks and insurers have had quite good digital capabilities for quite a long time, but customers still traditionally, certainly in South Africa, wanted to meet their broker to buy insurance. And it was only once that they stuck at home and they can't meet their broker in person that they start to say, okay, well, maybe I want to interact with my insurer online. So then the question becomes is how, so the new fintechs are very well equipped for that, but so are the old insurers. So, it's a human behavior thing.
Arthur, somebody asked a question a little bit earlier, and maybe this is a way to talk about, what's happening, kind of entree into talking about what's happening locally. Doug Vinegar asked, is Robinhood like easy equities? I mean, I think there in the investing space, there's been some very big sort of changes in people's investing habits. Maybe you can talk a little bit about easy equities and Robinhood and what they do and why they're different from how things traditionally worked.
I can't talk specifically about the difference between those two. I'd have to compare them side by side. But what I can say is that there's been a flourishing of online share trading platforms that have allowed people who would previously have been kept out of that whole environment stuck to local shares, and I'm talking about from a South African point of view, now are able to invest globally. There's another platform called eToro, for example, where you can trade it's essentially a social trading platform, but where you can buy shares from around the world. You can buy cryptocurrency, you can buy the various instruments that are available to international investors. The one thing that still holds us back from that, though, is exchange control. And I saw Doug asked another question about whether it's time to do away with exchange control as well. And it's a good example of where exchange control actually limits our financial freedom and our ability to not just compete globally, but also invest globally. There are ways to do it. There are instruments and routes through which you can do it, but all of them require you to work through third parties, to work through convoluted systems and the likes. So exchange control has a lot to answer for. And if I can just, while we're on that topic, mention another context why exchange control has actually been harmful, has been the way that it treats intellectual property, and the transfer of intellectual property has actually held back local startups over the years, kept them from, for example, engaging in partnerships with global players, attracting investment globally. That has apparently eased over the last few years, but it's still a big issue. And it's the reason that a lot of our best and brightest in the startup environment, in fact, leave the country and base themselves elsewhere, because they don't want to be held back by that kind of artificial constraint. So you see it as a constraint. I mean, one can see it as a constraint both in terms of entrepreneurship and tech evolution and development, as well as from an investment point of view. So it covers actually all bases of this particular discussion we're having. And it's an important area that needs to be unpacked further. And perhaps Dominique has deeper insights into whether the Reserve Bank is being more visionary about it and is likely to become more of an enabler rather than an obstacle.
Look, there's a lot of lobbying around this, around how to deal with IP. The Reserve Bank did make some relaxations in terms of loop structures. Because that had been what a lot of technology companies in South Africa do, is they offshore their IP and then they develop what's called mirror structures, and then it's quite difficult for those entities to become single structures again. But by sort of relaxing some of the loop structure regulations, the Reserve Bank is moving towards it. But like anything, there's a lot of lobbying, there's a lot of consultation. These things have second order effects, and it's going to take time. Tim, if you don't mind, if I can go back to the previous question around Robinhood and easy equities, because I think it's quite an important nuance in this whole story that's probably useful for some of the listeners to understand. Is so what easy equities in South Africa has done is really revolutionize the ability to buy shares. And the reason they did that was they do something called fractional share ownership. So I don't necessarily have to buy an entire MTN share. I can buy a portion of that. The trade-off is that easy equities is effectively doing market orders. So you're buying in at an average price. So you're certainly not going to use easy equities if you are a live trader who wants to sort of trade prices of shares on a daily basis and sort of, move intraday. Whereas Robinhood was allowing people to do active retail trading. So they were buying the shares at a point in time. Although what Robinhood had also done was created derivative contracts off the back of that, so people weren't actually buying shares. So that's quite an important nuance, is that easy equities is a great platform for you to come in and own shares, and you should own shares for a long period of time. That's what Warren Buffett always talks about, but it's not going to allow you to do active trading on shares because that would be very expensive. You'd have to pay the brokerage across every time you did a transaction, whereas Robinhood was enabling it. So that's one of the big differences.
Yeah, that's interesting. And maybe just take that a little bit further. What other interesting fintech efforts are going on in South Africa, both sort of that are available for everybody now and also that may be coming up in the future?
Who's that directed at?
Both of you, actually. Go for it, Tommy. through
So
it.
this is obviously, I mean, this is my job, which is why I always say I've got one of the best jobs in town. Is I kind of get to look at what's happening in fintech and sort of understand all the startups. You know, we run everything from sort of very early stage incubators where people just have a concept on a piece of paper and are wanting to start the business, to investing in businesses that are generating millions and millions of dollars per year in revenue. So there's a full spectrum. So I think the one thing that people maybe aren't aware of is how vibrant the SA fintech sector is, the quality of the businesses we have here, the quality of the entrepreneurs behind them. And this is a sector that's actually, I mean, South Africa has kind of been building a fintech sector probably for about 20 years. So it's not a new phenomenon. But I think what encourages us here from an Alpha Code point of view is we run this incubator called Alpha Code Incubate every year. And we just look at the number of applications. So when we started the program 5 years ago, that year, I think we got 15 applications. In this last round, we had over 300 high quality applications. So that just gives you a sense of how many people are moving into the space. And I think what's really exciting is that it's across the spectrum. So we've got people that are trying to tackle problems in insurance. So they're trying to look at how can they make insurance more digital. They're looking at how can they do sort of pay-as-you-go insurance. They're looking at how can you build insurance products for the gig economy. So, for example, you know, is there if I'm a contractor or I'm an Uber driver, it's quite difficult to get traditional insurance. So can I get an insurance product that's tailored to me there? We've got a lot of businesses in the payment space who are trying to make mobile payments mainstream. We've got really interesting lending businesses. You know, on the lending side, it's everything from, you know, when we think lending is some of the sort of bad payday loans, but there's businesses now that are enabling employees to get access to their earnings. So if I'm on month 2, more so day 2 of my month, I can access that portion of my wages as opposed to waiting at the end of the month to get my full salary check. So I think it's, you know, it's across the board. Every single financial services product that you can think of, there's fintechs that are coming in to try to do it better or do it differently.
That's great. What's Arthur, have you seen anything that you particularly like?
Yes, in fact, what we've seen in the past year has been a flourishing of fintechs and other startups in a range of areas, and partly, and this is also going to be creating a massive frenzy in the next 2 weeks, partly a result of this Section J12 of the Income Tax Act that allows you to invest, I think it's up to 2.5 million rand in a venture capital vehicle where you can get, I think it's 45% tax relief, but it translates into 100% tax deduction of your full investment. There's all kinds of rules around these funds. They're essentially venture capital funds that can't have all their investment in one entity. So they've got to spread it out over a number of startups in effect. And this has really galvanized the startup environment. It's made money available that wouldn't have been available before to startups, but also provided investors with an entree into the world of startups without having to manage it. Some of these J12 funds are incredibly well run with amazing portfolios, very similar to the kind of portfolio that Alpha Code has. You find in some of the Section J12 companies like Collett, for example, has these incredible fintech entities under its wing. It doesn't own them, but it's a major investor in each of these entities. And you find it across numerous categories. The most interesting one is one that's focused on cannabis-related products. So they obviously have to find a range of companies that invest in cannabis. Now, the reason why it's going to create a frenzy over the next 2 weeks is because, firstly, tax year ends at the end of February, and this particular allowance actually has a sunset clause built into it. You can only invest, or the funds can only be activated until June this year, I believe, although SARS may decide to extend it. At this stage, the concept ends in June. So in terms of the tax year, people have 2 weeks left to take advantage of it. It's a massive tax incentive, but it's an even bigger boon for startups. And fintech is probably the biggest beneficiary of all.
That's interesting. I'm just going back to a couple of the questions, which are just fascinating. Tejolo Ligida asks, what future-proof studies are there that young professionals should be studying now to advance their careers in financial services?
That's my favorite question, Tim.
What is it? Okay. Well,
it's not a specific course of study. My advice to almost anyone looking for career advice who's going to university now, starting to study, is that whatever you study, make sure that it is a course that takes into account the impact that artificial intelligence will have in that segment. So if they utterly ignore artificial intelligence, then it's probably a career that's going to be extinct in the next decade.
Do you think, by the way, that universities have kept pace with what's happening technologically? I mean, obviously they're responsible for a lot of it, but you know, if you did CFA now, would you study Bitcoin? Dominique, do you know?
I don't know about that, but Tim, I think the question, it's a very interesting one, and it's one that we've had a lot of discussions about. And I think I'll give you a practical example. We run a program called Alpha Code Explore. So there's an amazing company down, it started in Cape Town, called Data Science Explore Academy. And what they did was that they created a program. It was a year long. So they got some of the best and brightest, actually some from academia and also some from industry, to create a program where for the first 6 months, students would learn the fundamentals of data science. And then they'd spend 6 months doing an internship in a company solving real world problems. Now, what was interesting, in their first cohort, they got 100 people into the cohort. A number of those people didn't even have matric. And then you had the range. Some people didn't even have matric, and some people had a PhD in artificial intelligence. But what the course was really testing for was your aptitude for data science. At the end of this year, the program, or the data scientists that came out of this program, were able to go into companies and solve real world problems and add value on day one. So what I always say to sort of young, you know, sort of smart people who want to get into fintech or to technology or into AI, and they want to go study actuarial science at UCT, I'm not saying that there's not value in a traditional degree, but what they've got to recognize is that there's programs like a sort of a Data Science Explorer Academy, where you, in a year, they can become incredibly useful to an organization on day one. So I also think the way that youngsters have to think about this is quite different, because getting some practical training is more interesting, and it is more relevant to companies in some instances. And it allows people who haven't had the means to sort of go and study for 4 years at university to get into the market. And I think that's what's exciting about the tech space and the data science space. There's a number of players also doing this in the technology development world. So it's changing quite a lot.
Yeah, and there's you shouldn't necessarily also be locked into a single institution or a single course of study, because there's lots of international opportunities now. MOOCs, lots of universities around the world are offer pro bono courses. Really, we are seeing. What was Arthur was talking about, Mamakwala and daisies popping up all over the place. Actually, I think education is one of those. Compared to when I was a kid, just getting hold of information is now, it's just an order of magnitude easier, and that will show. In the future, I would expect. Listen, I think we should stop. I mean, people we are only allowed to go for an hour, but there's a whole bunch of questions that are coming in that I think are very interesting. But we could go on forever. Just one little quick one. People are asking for details about courses that people could do. If the two of you could put your maybe get together afterwards and send us a list of the courses that you think would be fun to do, that would be really great. The other one, somebody mentioned life insurance and property brokerage. This is Nick Wood saying this is where they're very high intermediary fees. And I think that's he's sort of wondering whether or when Fintech could play a role in either of those spheres.
Sure.
You know what I think is the interesting part of the question is really about intermediary fees. This is because a lot of fintech is aimed at ease of use and sort of targeting areas of traditional high fees. What do you both think? Maybe we should end on that. If that's
happening, Tim. So you have some great examples already of fintech insurance companies that are cutting out the middleman, allowing people to go directly either online or via an app. And you've got some fairly visionary little operations, startups, that are totally disrupting traditional insurance. I think of Naked Insurance, for example. I think they are in partnership with Momentum, if I have it right, who are the major investor or backer of them. And it's almost a case of Momentum realizing that if they don't disrupt themselves, someone else is going to. And you're going to see that more and more with insurance companies, that they'll either partner or invest in startups that fill the gaps that they aren't able to fill themselves, or they don't have the right entrepreneurial spirit or the enabling environment internally to do so. But you will find that small entities and nimble entities are going to run rings around traditional insurance in particular.
Cool.
So, Tim, I think this is an interesting question. I think, there's actually been sort of straight through processing online digital insurance has actually been available in South Africa for over 10 years now. It's not a question of technology. It's a question of human behavior once again. So I think the challenge with insurance is that it's a product that's sold. It's not a product that's bought. And what I mean by that is people don't necessarily wake up in the morning and say, oh, I want life insurance. It's generally triggered by an event. So, for example, you're buying a house and you need to get life insurance. You have a new baby and you suddenly think about life insurance. So what's really powerful are going to be the companies that think about those touch points with the customer. So are they able to either integrate their technology or develop interesting partnerships so that they are touching the customer at the right point in time? Less about the actual technology, because the technology exists. It's just how do you access the customer? The concept of sort of going direct to the insurer was pioneered by OutSurance kind of 25 years ago, where they said cut out the middleman and phone us for a quote. But 25 years on, brokers still exist because people do like to buy insurance from people. So it's more a question around distribution and customer behavior, I think.
And property brokerage?
It's not a space I know that much about, but it exists because there's a lot of information asymmetry. It's quite an opaque market. It's quite difficult to get the data that's needed to make that completely virtual or to move it online. But also it goes down to a trust factor. The challenge is that when, for example, a company is looking for a new office block, it's a big investment. And they probably want to work with someone who knows the space really well. Not to say that technology doesn't have a part to play. I think what technology can do is enable the broker to service their customers better. But I think we're quite far away from companies planning a 15 million rand office move and doing it completely online. That's just my assessment at this stage.
The problem with that environment is that the information is still quite expensive. There's a company called Lightstone Properties that collects vast amounts of information on property. And if one is able to plug into their data, it would simplify decision-making. So there's probably room for apps that integrate their data and allow people to very quickly and easily get the information that they want or need, or information that will affect the value of a property. But it's not commoditized information. It costs them a fortune to gather that information and to aggregate it. So until we have commoditized property information, I have to agree with Dominique.
Yeah. All righty. Okay, here's the last question. Very simple. Choice 1, 2, or 3. Shannon Bernard asks, would you invest today in 1, Luno, 2, Amazon, 3, Ethereum? Arthur Goldstuck, go.
None of the above.
Dominique Collett, go.
All of the above.
Guys, thank you very much. This has been a great conversation. I hope I just want to thank everybody for being involved. There's a whole bunch of people behind the scenes who've really helped, and also to thank our sponsor, who is Uber Eats. Really, it's nice that they should be sponsoring an event like this. Thanks very much, and goodbye. Have a good evening.
Thank you.
Afternoon. Ciao, ciao.